Thank you very much, Fred, and let me thank you all. Thank you, the Peterson Institute, and to thank Bruegel for this project. I think for us it was an exciting project. We wanted to deepen to contribute to deepen the transatlantic relations. Actually, I'm just out of with the Commissioner Almunia, out of a meeting with Larry Summers, and all the issues that you discuss here in the book came up with Larry expressing strong views as usual. So I think it's nevertheless very important to discuss this and to continue to discuss this. I mean, when we launched this project, actually we were in considerably calmer waters. Then when we had the conference here, it was just on the verge of the Lehman disaster. And then now we launch the book with the events unfolding, with everyone around looking for green shoots here and there. We hope we find something. We hope that by the autumn meetings will come here, having realized that indeed we see some small light out there. Still not sure, and I think one has to be then continue to be very cautious. I think it shows also that I mean, Commission as usual is very open. I think ready to learn. I mean, there are many things in the book. I remember also the interventions by Adam last time, which are very controversial, not very kind, but we take them I think with grace, and we are going to think about it in a very serious way. I mean, maybe just to offer a few reflections to lead into the debate. We published on the 10th year of EMU a comprehensive study in May last year, so almost exactly a year ago. And we had there a number of conclusions, a number of policy prescriptions. Of course, we were in the middle of the crisis because, I mean, the crisis actually erupted July, August 2007. But it was not the kind of explicit, let's say, meltdown that we have risked. I mean, in the latest months. So overall, by the current standards, there were calmer times, and we came up with a number of prescriptions on the domestic agenda for the euro area, on the external agenda, and on the governance agenda. So I would like to offer you maybe a few reflections, revisiting a bit what we recommended at the time in the light of what we are experiencing now, to see whether did we get it completely wrong? Do we have to change tack completely, or actually do we have to continue on the same track, maybe accelerating the pace? And then, of course, I mean, we'll listen to all of you for your opinion. I mean, what did we recommend at the time? And we had in the domestic agenda, the recommendations was to deepen the policy surveillance that we do in economic and monetary union, and to broaden it. I mean, deepening means essentially that the fiscal framework that we have, the Stability and Growth Pact, should have better grip. I think better behavior in good times to create the surpluses that you can then spend in bad times. And broadening means that one should go beyond the focus on fiscal to encompass other dimensions, in particular the issue of external imbalances within the euro area and the vulnerabilities that go together with that. To encompass the role of financial markets and the transmission mechanisms that financial markets imply for the working of monetary policy, for the working of fiscal policy, for the adjustment within the euro area in terms of reallocation of resources, in terms of risk sharing, etc. This was the, let's say, the gist of the recommendations on the domestic agenda. On the external agenda, we actually looked a bit at the title of the volume here, leaving the question mark at the end, of course, next global currency. But we saw, let's say, an evolution of the euro as gradual but acquiring a stronger weight in the international scene, and calling for Europe and the euro area to streamline its voice and the representation of international financial institutions, and seeing that, considering the political difficulties, as a medium-term projects. So highlighting the needs, but recognizing the political constraints on that. And the third dimension was the issue of governance of the euro area, and in particular, at the time, what we saw, the possible fading role of ECOFIN, which is the decision-making council for the whole European Union, actually taken over by the Eurogroup, which is the informal body managing the euro area. So, and we said, look, we have to make sure that ECOFIN remains at the center, and it's not crowded out because we need to have a collective decision-making, and that should be done by ECOFIN. Now, in the light of what we have observed in the crisis, how do we revisit this? I think on the issue of the domestic agenda, deepening fiscal surveillance has, I think, come to the fore. We had to adapt our fiscal framework in a dramatic way. Because the fiscal framework was to keep deficit under control, go to close to balance, to let room for automatic stabilizers and maybe for some moderate discretionary policy, but without, let's say, endangering sustainability of public finances. Looking at the deficits and the increase of debt that we are experiencing now, directly or indirectly due to the crisis. I mean, the fiscal framework had to be adapted, had to be implemented in a more flexible way. Nevertheless, I think it is important that we maintain a sustainability anchor in all this. And this is not only because we care about the medium to long term, but also because the effectiveness of the fiscal stimulus that we are administering to the economies now, actually the multipliers depend on the confidence that you maintain in the medium to long term. If there is an anticipation that higher deficits and debt becomes entrenched, then the multipliers themselves, actually in our studies now, are cut by half. So because you have you have more, let's say, the typical Ricardian effect come into place. So for many countries, entering the crisis with relatively high deficits and debt has actually reduced the room for maneuver and the fiscal space. So not having done, for several of the euro area member states, not having done their homework in good times or in relatively normal times, then limited the room for maneuver in bad times, and these are indeed very, very bad times. The other element is the broadening of surveillance, and clearly there are some vulnerabilities within the euro area. I think the attention that we have to put on intra-euro area external imbalances and the way we tackle them so that they do not become a permanent feature, but an adjustment feature of the euro area functioning, I think is very important. That has been reinforced by the emergence of the crisis. Actually, within the euro area, some of the countries more hit by the crisis are precisely those which more exposed in terms of the model of growth, higher external imbalances, reliance on external capital, and a model of development based on, let's say, asset booms and real estate. So those actually take Ireland, you take Spain, those which have been more exposed. So here again, I think it's will have to do we'll have to do more in order to encompass this dimension here. On the external side, look at the G20 that we have had just in London. So the objective there of consolidating voice and representation, which was a medium-term objective in our study at the time, becomes a short-term one. It becomes a very short-term one. I mean, now in London we'll have to review, the agreement is that we come to a review of quota and representation by January 2011, so basically the day after tomorrow. And there it is, we know what are the expectations of emerging countries, and rightly so. So I mean, the Europeans definitely they have to get their act together in order to overcome here the paradox of having too many seats around the table, and precisely because of that, too little power. So I think this, what we saw as a medium-term objective becomes now something very much on top of the policy agenda now. In terms of governance, I think the crisis has shown that ECOFIN is back in the driving seat compared to the Eurogroup. That's normal. I mean, you have, if you think about financial integration in Europe, response to the financial crisis, you have on the one hand London, so you cannot do without the UK, and you have the whole, let's say, Eastern European dimension, where there are high vulnerabilities, at least in several countries. So, in the financial area, the Eurozone cannot do alone. So there, I think we have to see the EU dimension will come forward with the proposals for reforming financial governance, for stronger, more consistent supervision, implementing the De La Rosière report, and they, I think, will make decisive steps towards stronger micro surveillance and stronger macro surveillance. And I think it will be very important to discuss also with the US how to have a financial architecture at the global level which makes sense and is consistent. So my conclusions here is that the domestic agenda has not changed substantially. It has shown that we need to accelerate in what we had figured out as key developments. The same goes probably even more dramatically for the external dimension. So we have to accelerate what we had envisaged, in particular on voice and representation, and we have to streamline and better organize our governance system to be able to punch at our weight. All this will have to be done in the context of a consistent, let's say, exit strategy. It is not too early to discuss about exit now. I don't think it is so much a question of timing, so don't discuss now because we are still in the middle of the crisis and you risk to get the timing wrong. I think we have to discuss about exit now because the kind of response that you give to the financial crisis will have to embody already, let's say, the exit, and not being seen as, let's say, a response for the short term. I will think about the medium to long term later on. And here I think the impact of the crisis on potential growth, on the capacity adjustment, innovation, on the need for stronger global governance, I think will have to be part of this exit strategy that we hope to, say, devise together with the US and other partners. Thank you.
Thank you, Marco. Adam.
Thank you, Fred. Thank you, Marco. Thank you, Jean. Thank you, everyone. It has been a great pleasure for me to work with Jean Pisani-Ferry and with our various esteemed authors on this project, and in particular to continue working with Marco, with the people representing the Commission and the European Union here in Washington as well. We are believers in the Euro project, not just because Fred wrote it several years ago, but out of a genuine intellectual commitment that we believe this is the right thing. And we believe very much in the Euro itself. And in a sense, the starting point for our volume is very different from the Euro at 5 volume I edited 5 years ago, in that we feel that the record is very clear. The euro has been a huge success on its own terms. And in the midst of the crisis, it's actually been an extreme safe haven benefiting the member countries in terms of keeping interest rates down as much as they've widened. They have not widened anywhere near what they would have for countries who had been outside the euro, as Eastern Europe is finding out. And not only in good times, but in bad times, the euro has been of true benefit to Europe. Now, for the people in this room who are a self-selected group, that may not be revolutionary news. And the study that the Commission did under Marco's leadership, the Euro Attend that he mentioned from a year ago, which we distributed last fall, a study that Bruegel did, also about a year ago now?
A
bit earlier, clearly emphasizes. So we sort of stipulate to that, and our project was then to go beyond and focus a little more narrowly and say, given that, what do we think will happen to the euro in the global sphere? What is going to be the euro's international role? What is it going to play in international monetary and financial governance? How is this going to relate to the dollar and the other leading currencies? And there we are, in broad terms, in agreement with a number of the initiatives, or at least priorities, that Marco sets out. But we do have, admittedly, a slightly more challenging view of where the euro stands and are a little less satisfied on this front. Now, why should we care about the euro's global role? I mean, this isn't a matter of machismo. This isn't, I want my currency to be as big as yours. Or as both Larry Summers and Erkki Liikanen put it in the volume, and you will be getting the nice, good volume. Everyone who came today will get the full volume shortly. Put it, this isn't about a national effort to be on top. The general advantages of being a reserve currency are both available to the members of the Eurozone, members of the Euro area, and to the U.S. We can both borrow in our own currencies. Seniorage has gotten slopped around a little bit, wasn't helped by the ECB issuing 500 euro notes. We're all familiar with that story. But in the end, for rich countries, this is a second-order issue. So why do we care? And I think what John and I and the authors of the volume would conclude is we care for two fundamental reasons about the global role, besides simply the predictive power, which matters for markets going ahead. The first is we think the way the euro has behaved and the Eurozone policymakers have behaved in response to the crisis reveals something about the underlying performance of the euro and the underlying determinants of the euro's functioning. And that while the euro has done very well in, as Marco I think correctly puts it, domestic terms, or I would say also in narrow monetary terms, there are some real limitations to what is still developing in terms of euro area functioning that we will talk about. The second thing is that we think there is a real role for international monetary leadership, and that for long-term reasons, as well as the recent errors of financial and economic policy in the U.S. cannot do that alone. And the euro is the only realistic alternative, or I don't want to say rival, but potential serious partner. Fred Bergsten, Randy Henning in our building have been writing for a number of years on the need for the euro to step up into this role and remind us, along with a number of other monetary historians, of the idea that you want to have an alternative so that when the leading currency messes up, there's something to shift to. Now, we don't believe that this is that moment. We don't believe the U.S. has messed up quite that badly, although it certainly has messed up. And we don't believe that there is an alternative to the euro. But we are still not ready to say that the euro is stepping up as well as it should be at this point, and that is a loss for both the U.S. and for Europe. And that portends a risk in the future if the euro, in a sense, does not seize this moment of recalibrating, making more multipolar monetary leadership, that we will have something of a power vacuum, which in a time of contractionary economies is not a very good thing, as Charles Kindleberger and many other distinguished economists have argued. So I'm just going to go through a little more specifically some of the conclusions we have about where we feel the limits to the euro's take-up as a global currency come from and what that says about the euro. And then John is going to take over and talk about what are the policy measures, the agenda that we would suggest. And that also draws on some work that he's done on his own, some of which is in your packet. In particular, we think that for all the success of the euro in domestic terms, we would emphasize three major obstacles to the euro's take-up as a global currency and playing a full international role. The first is, for all the progress on European financial integration, it remains well behind in depth and integration what the American money markets look like, what a number of other financial markets are, and that does still constrain the attractiveness of the euro. And this is best demonstrated by the fact that in this time of crisis, the flight to quality, whenever somebody with money wasn't just bringing their money home to wherever home was, remained to U.S. treasuries, remained to U.S. assets, even though arguably much of the crisis began in the U.S. Kristen Forbes, the distinguished MIT economist, did a very nice contribution to the volume in which she goes through this in, I think, very sober detail, also echoed by Philippe Martin, who did another volume on the importance of financial centers to determining how markets function as an attractive force for capital. And underlying both of these is the fact that while monetary and financial integration have gone very well in Europe, particularly in the bond markets, there are a number of other legal, institutional, and particularly governance barriers that make it less attractive and less liquid. It isn't about you get higher returns on average in the US. It's about these other qualities. The second point that I would make is that we're very concerned about euro governance, euro area governance, in terms of crisis management or in terms of representation at the global level. And here, frankly, I don't think we're saying anything controversial. We've actually been singing from the same sheet as the Commission for a long time, which is part of the reason we have certainly welcomed Commissioner Almunia to come here and speak on a couple occasions very frankly about the need for greater euro area coherence and representation. And again, Randy Henning, our colleague, Ted Truman, now at the Treasury and coming back to us soon, have both written about this as well. This is not new noise. But what we do talk about, and in particular in Jean Pisani-Ferry and André Sapir's chapter in the volume, is that the ability of the Eurozone to react to crisis, particularly in the non-narrowly monetary area, has been limited. We look back and we can see the ECB actually being ahead of the Federal Reserve and ahead of the Bank of England, for example, in early parts of the crisis in 2007, in the first half of 2008, in terms of providing liquidity to a wide range of counterparties very coherently and very well. But as we characterize it, the responses to some of the banking problems have been more ad hoc and have run up repeatedly against national supervisors and national interests. Now, one can, of course, cynically shrug one's shoulders and say, gee, that's just the way it is. It's national governments that have to bail out the banks when there's a problem, so that's how it's going to be. But in the same spirit as the De La Rosière report, we would emphasize that this is not how it has to be. And if anything, along with the other governance issues that are better known, these issues do constrain the global use and trust of the euro. Third, and this gets into probably the most controversial part of our remarks and based on my comments in the book, we are very concerned about the way euro area member governments and the euro area as a whole has responded to the crisis in Eastern Europe. As our colleague Anders Asland has pointed out, which is a copy of which is in your packet, the G20, in terms of mobilizing the IMF and resources for the IMF, has done a great deal for Eastern Europe. And it is certainly understandable and in some sense perhaps even preferable for euro area governments to say, we don't want to impose conditionality on Eastern Europe. We want to have it done through the IMF on a multilateral basis. But if we're talking about the euro area as more than just a monetary relationship, and if we are talking about the euro as more than just a regional currency, that is not how you want to go. You do not want to be abdicating responsibility for the bailouts and for the performance of your near neighbors, your fellow European Union members, your closest trading partners, to a very strict and I would argue excessively narrow interpretation of the rules. We have the irony that at the very same time that euro area membership becomes all the more appealing, countries like Poland or even Denmark that were opposed to or reluctant to go through the hoops for euro area membership are all the more eager right now, seeing its benefits. But at the same time, those goalposts are being moved further away from them by a lack of consideration, a lack of flexibility. To me, and this I will take responsibility for the next statement and not incriminate Jean, to me, I find it rather odd that what should be the euro's moment, it has gone into kind of a defensive crouch. It has said we cannot extend euro area bonds because that would imperil our price stability and our fiscal policy, even though that's to help out these small countries. We cannot loosen the ERM2 requirements to keep countries in a waiting room for an extended period of time, even though, as the IMF European Department, I think, has quite accurately said, it might be useful to accelerate Eurozone membership. And we are going to go with a strict conditionality that sets Poland against Hungary, Bulgaria against Romania, Slovenia against Latvia, and country-by-country comparisons, rather than engaging in Eurozone and European solidarity, asking who does the right thing. This, again, may be narrowly correct in terms of both the statutes of the Eurozone, in terms of maximizing its price stability. But it is, to me, short-sighted and part of the way that the Eurozone undercuts its claim to becoming a regional, more than a regional currency, and in fact lets down its region in an important way. The final point we would make, we had some excellent contributions in the volume for people taking regional perspectives on the take-up of the euro outside of the euro area. Mohsin Khan, who recently joined the Institute, did a short paper on the take-up of the Gulf companies, the Middle Eastern oil exporters and other oil exporters in the euro, and has since published a much longer working paper that just came out from the Institute on this topic. And he concludes that while, for example, Kuwait went off its dollar peg, fundamentally the GCC countries are still orienting towards the dollar, and it is quite practical for them to continue to do so, despite the ties to Europe. Randy Henning, who's done a lot of work on Asian monetary cooperation, goes out to Asia, and he is certainly a euro fan, but in our volume also finds that there hasn't been huge take-up of the euro there, and if anything, the crisis tends to accelerate moves towards Asian monetary regionalism, not to a switch to the euro. The distinguished Hungarian economist Georgi Zapari, and forgive me for mispronouncing it, came in and talked and documented how the euro, of course, is becoming much more widely used in Eastern Europe, both among EU members and future or potential future members. But echoing something done by Linda Goldberg in her chapter on trade and invoicing in the book, it's only been growing in use to the degree that the real side ties between Europe and the real side ties between euro area members and the non-members are growing. There is an increase in financial integration, there is some euroization, but it really is still driven by the real side of the economy and not so much by other factors, which again I would argue represents the euro area leadership deciding to make it difficult rather than easy, deterrent rather than opportunistic to get countries involved. Finally, we had a market view from Thomas Mayer of Deutsche Bank, a very well-established European market economist, and he echoes things that were said using similar imagery to Jean and Andre's chapter about euro area ready for the storm. That the markets do, of course, perceive the euro as a stable area. And of course, and I would say this, anybody who bets on those intra-European interest rate spreads is going to probably lose a lot of money in the end. But that's far different from saying that the 10-year-old euro is the economy or the currency that you turn to in time of crisis, which gets us into the crisis management issues we're concerned about. So let me leave it there and turn to Jean for where we would go from here.
Thank you, Adam. Before I start, let me say how pleased we are to collaborate with Peterson on this project and on others. Fred was kind enough to say that we are the sister institution. I don't know whether it implies that the Peterson is a brother or another sister. Let's leave it open. But anyway, there's a spirit of family and cooperation, and we're very happy about that. Let me also say that, the Commission did not only provide support to the study, but I would like also to commend what the attitude of DG ECFIN vis-à-vis external approaches, criticism, debate. I think that's extremely important, not only for us researchers, but also for the evolution of the policy thinking. And we may criticize the Commission for what it does, but I won't criticize the Commission at all for the lack of openness to ideas. As Adam said, crises are challenges to existing orders, and this applies both to the global order and to the order within the euro area. And very much it's what we're saying, that this being a challenge to the global order, this crisis creates opportunity for the euro, but at the same time it reveals some weaknesses inside and challenges some commonly held views on how the euro area should work. And how that plays out, how this combination plays out, what degree of initiative there can be and of learning there can be for the euro area will be essential in determining what's the consequences of this crisis for the fate of international currencies. Let me take just 3 points because we want to save time for the discussion that come back to some of what Adam said. And actually, I don't want to distanciate myself from your strong words. I mean, we're in full agreement on that. On integration, and especially on financial integration, we are crossing the river and we are discovering that we are just in the middle of the river. Everybody in Europe quotes this sentence by Mervyn King about banks. You know, banks are global in life but national in death. And that very much captures this tension there is about the incomplete integration and the two twin discoveries, both as important as the other. On the one hand, that in fact you have this degree of integration that goes beyond borders, and that the cross-border dimensions of this banking crisis are present at each and every moment in the discussion, and at the same time, the rediscovery of the fact that whenever we speak about budgetary matters, we're deeply into national responsibility. And this tension and how it's going to be resolved is essential. So Marco said we have now the blueprint, that's the La Rosière report, and we're moving towards implementation. I think that's a good news that because it's a thoughtful report, it's a good analysis. At the same time, we don't know whether it's going to work because it's very much a compromise between those different aspects, those different dimensions of the tension. It's very much a rather cumbersome process of creating committees and committees over committees and coordination between committees, and we don't know whether it's going to work. So this tension remains. This tension at this stage cannot be addressed in a very radical way. I think we have to recognize that, and that's why the La Rosière report is the game in town. But the question remains how good we will be in addressing the tension. A word on the bond market that Adam mentioned. We don't discuss that in detail in the book, but Christine Forbes in her chapters points out very clearly that one of the key reasons, and perhaps the key reason for the attractiveness of the US is the depth and the integrated character of its financial market. So fragmentation within Europe has a cost. Now, what we have discovered is that, in fact, this fragmentation can show up in the risk premia and in the widening of the spreads. So that markets are finally pricing the national risk that for a decade they hadn't been pricing. Whether there would be a possibility for creating an integrated bond market is an issue that in discussion that has started to emerge. It has started to emerge not in a very precise way. There is no blueprint on the table. There are some ideas floating around that there could be some ways of ensuring that the gains from integration would not be compromised by the risk of blurring responsibility over national debt, and that very much a tension that has to be addressed. But it's a discussion that is starting. So I wanted just to mention that, saying that we don't have proposals on that. On crisis management. On crisis management, we have discussed that in the book. And I think first we have to recognize that the notion that there can be a crisis within the euro area is very much part of the conversation now. It wasn't. The very basis of the treaty, of the thinking behind the whole policy framework, was that prevention would do the job. that essentially there was no need for provision for crisis management within the euro area, because by being part of the single currency, you would eliminate the risk of national crisis. Now, we see clearly what a crisis could be. We see with the spreads widening that at some point, one country could be facing an inability to raise money on the bond market, and that would be the type of crisis we would have in the euro area in economic terms. Now, what we have seen is that this perspective, this possibility, in front of that, we don't have the clear instruments for managing this type of crisis. Because, again, this notion that prevention would eliminate the problem resulted in first creating a differentiation between countries that are members of the euro area that are eligible for financial assistance, so we're able to lend money to Hungary or to Latvia, and countries within the euro area that are no more eligible for financial assistance. So that's a technical problem of having the instruments ready. We have a second problem, which is the fact that there's a question of which institution should be in charge of monitoring the lending to a country we would wish to assist, and especially which institution should be in charge of conditionality. We have a global institution for that at the IMF. We don't have an institution within Europe because that's not essentially the job of the Commission. The Commission does not do conditional lending on an ongoing basis as the IMF does. It could do it. The question is whether we want to go for a solution that would be, in a case it happens, whether we want to go for a solution that would involve the IMF or whether we would go for a European solution. The policy thinking at this stage is let's go for a European solution because the political cost of calling the IMF would be too high. I understand that. At the same time, I have my doubts on the feasibility of this type of solution because not so much because of the technical problem of having the instruments or not, because we couldn't go around that problem, but because that's a very specific business. You need to have a staff that is especially trained to that. And you need, more importantly, you need to have an institution that's built to resist the difficulties that this kind of lending of business creates. The IMF is not, at core, a political institution. The IMF is a technical institution, and everybody knows that the IMF can afford to be extremely unpopular in a country. It's not true of the EU. The EU is a political institution, and having the EU being tough on conditionality vis-à-vis a member country, would possibly create a political problem that we would need to be aware of if we start going in this direction. So I would be sympathetic to the notion that there needs to be a European dimension, there need to be a European stage, but I wouldn't exclude entirely the idea of going to the IMF. The more on crisis management, the broader issue, as Adam said, is how we address the problem that our policy system was not built for crisis. Our policy system was built for fair weather conditions. So the notion that prevention, that rules eliminate or make extremely unlikely the possibility of crisis, and therefore that we don't have a crisis management facility. How did we address the crisis? Very much on an ad hoc basis, by ad hoc coordination and cooperation. And that's good to be able to do that, but it's good also to have procedure and institutions that are able to perform their role in times of crisis. And if you think about it, what you expect from a policy system in times of crisis is just the opposite from what you expect from a policy system in normal times. In normal times, you want predictability, you want rules, you want, to make sure that you play essentially an incentive rule book by which various players can know the rules and conform to the rules. In crisis time, you want centralization. You want flexibility, you want the ability to think out of the box and to take initiatives that are not in the rule book. And that's very different. So we have a system that is tilted towards the normal times does not have the sufficient ability to deal with crisis, and that's something we may have to reflect on. The Eurogroup that Marco mentioned was in fact the institution created in a way to address the residual problems that were not envisaged in the rulebook, because the Eurogroup did not have a precise mandate. In fact, the Eurogroup did not pass very well the test of crisis. It was expected to be able precisely to take initiative at this moment. It did not take so much the initiative. So I think that's in a way a casualty of this crisis. To end on the external and the regional dimension, the external dimension, certainly, Marco said it has become external representation, consolidated external representation has become a short-term objective, and I agree with him from the perspective of what's changing in the world economy and the world governance. The reason why it's not happening, in my view, are twofold. One is very much what I could call the Dubarry syndrome. This was a French, the mistress of a king, of Louis XV, who, when she was brought to the executioner to be beheaded, said, one little moment more, Mr. Executioner. So you know it's going to happen, but you play time, because it's so nice to be there at the table. So if you gain just a few years, that's all benefit. But there's a deeper reason, which is the quality of the internal governance. Because you don't want to go for external representation if you don't have the internal governance in place that makes this external representation effective. Otherwise, there's no gain. And here, we have seen the problems in internal governance in this crisis. We have seen a certain weakening of the institutions. We have less appetite, I should say. I think my diagnosis would be that there is less appetite for external representation now than there was 10 years ago, because the internal strength of the system and the ownership in it has weakened. So that's the difficulty we're in, and it's key to see whether we're able to address that. Finally, I won't say much more on the regional dimension than what Adam said. I think a key message of the book is that the regional dimension has to be taken extremely seriously, that you don't become a world currency if you're not a successful regional currency. And that requires, exactly as he said, that requires to play beyond the script, not to just look at the rules of the club as they are, but recognize that in the club there are different types of members, some of which are shadow members or clandestine members, associate members, honorary members, all those not really envisaged in the treaty, but that's a reality, and you have to confront the reality. So you have to cooperate and to consider that you have a role in bringing stability to the region. And if you succeed in bringing stability to the region, then this is a platform for doing more. So what does it mean? It means cooperation, monetary cooperation. Swap agreements are a key example. The Euro, the ECB is not doing what the Fed has done with a number of emerging countries, or at least not yet. Second, it requires a clear and better path into the euro. We have criticized the entry criteria before the crisis. In the publication you mentioned, we criticized the entry criteria for not making good economic sense. I think it's even more true in this situation. It's not a question of softening the criteria. It's a question of having criteria that make more sense. And I would say we have to also look at the overall situation and the debt in euro or other foreign currencies that has been incurred by private agents in the region, and the threat this represents to future prosperity. And that's something also that needs to be addressed. So very much consistent with what Adam said, I think, again, this creates clearly it's a test, and on many fronts, and first of all on the strength of the euro and the fact that in spite of all talks by market participants about the breakup, the reality is just the opposite. The test was passed, but in some other aspects, the test still has to be passed.
In your initial remarks, Marco, you made a very tantalizing comment about the need for discussing the global architecture with the United States and perhaps thinking about additional transatlantic cooperation in that respect. And I would simply ask if you could elaborate on that view with your own thinking and any results that have come about as yet from your discussions with your American counterparts on that possibility. But more broadly, to ask you to respond to some of the questions that have been raised, and then we'll open to the audience. Marco.
Okay, thank you very much. Actually, very nice comments, as usual, by Adam and Jean, and provocative, as they should be. Now, let me give take a couple of points. Actually, take 3 points. One, which is across the two interventions, the response to the crisis and the fair weather architecture that we have in Europe compared to something else which would be needed for stressful times. I think that may be a fair comment. We do not have, let's say, an efficient or fully efficient, governance structure. We would like very much to have the possibility of, better decision making, more swift search of consensus. But then I ask myself, I look from Brussels across the Atlantic, and there we are supposed to have all this. And then I look back in October at the time of the conference, and Lehman Brothers was not in Europe. The mess was made here, with all the kind of swift and a very efficient, let's say, waterproof architecture, which would imply, strong decision making. If one looks then beyond that and at the response to the crisis, the TARP mess was not made in Europe. TARP.
Oh, TARP.
TARP. If one looks at the what is coming out from the G20 blueprint for response to the crisis, one may like that or not, but the let's say the three-pronged approach in terms of government guarantees, in terms of recapitalization, in terms of let's say treatment of impaired assets. Look at the G20, not the London summit, but the ministerial one in Osham a week before the summit, or 10 days before the summit. There is the conclusions, an annex on how to deal with impaired assets. That's precisely what has been done, has been devised in Europe beforehand, in the guidelines which were published by the Commission, which was, almost, perfectly overlapping with that. Now, I acknowledge in terms of implementation, we are lagging behind. There is more to be done. We have seen the estimates in the Global Financial Stability Report by the Fund in terms of recapitalization, stress test, acknowledgement of, losses. More has to be done. There is an element of adhocery. But I do not see elsewhere in the world something that is better than what we have done, and I can see a lot worse, actually. So the conclusions that one would need a better governance system, a better decision making, that does not necessarily, which I would acknowledge, which does not necessarily translate immediately into better and more consistent policy. I don't see this as emerging from the crisis. This was first point. The second point, I think I cannot let go, is the impression that we let our Eastern European countries, on the side, not caring about them. I think this is actually not true. It's not true at all. I mean, we have adopted, we had a facility, balance of payment facility to support EU countries in trouble, non-euro area countries, which until a few months ago was of 12.5 billion. We have doubled it twice to 50 billion euro in the European Council about a month ago. We are already together with the IMF and establishing the conditionality and implementing the programs together with the fund, helping. We started with Hungary last year. We have Latvia. We have Romania. More will come, unfortunately. That's my modest prediction here. So we are doing all this, and we are helping them out. We have also, as part of the European Recovery Program, where we tell, we have decided with the member states how to respond in terms of, expansionary fiscal policies. We have also accelerated the flow of funds from the EU budget to these countries, in particular to these countries. So from the structural funds, for the social funds, etc. So we are helping them, and they benefit quite a bit from this. In the implementation of competition policy, we are very, very careful about home-host relations, and we make sure that in implementation of the financial rescue packages, there is not the withdrawal from these countries, from the parent banks in other members. These are explicit conditions. And I think that is, we are, in spite of the fears, and I hope that this will not materialize, but so far we have not seen, wholesale withdrawal of funds from these member states. We are now discussing with Romania, with the parent banks, 9 parent banks in several European countries. I mean, there is a explicit commitment on rollover recapitalization of the stress test. So I think this will help the country. Now, true, we have not gone for a let's say uniform approach vis-à-vis Eastern European countries. But this is not so much because the Commission dragged its feet, or because the old member states did not want it. It is because the new member states themselves do not want to be put in the same basket. Now we have had last week the flexible credit line applied after Mexico, the first time to Poland. They are not in the same basket. They refused themselves when there was the proposal of the Hungarian Prime Minister to have a huge fund to bail them out. Altogether, the others told the former now Prime Minister of Hungary, no, we don't want that, because we are not in the same basket. We have a differentiated situation, so you have to treat us on a case-by-case basis in a different way. On the euro area entry, well, first of all, that the club is not closed is evident. I mean, we have just enlarged to Slovakia, with Slovenia, Cyprus, Malta. Is true that we have not enlarged to all the others. I think we have to apply primary law here. I mean, in Europe, believe it or not, is not a bureaucratic exercise. A treaty counts, and the treaty counts. And if we would not have the kind of reliance on rules-based mechanism, which sometimes lead to, let's say, on a partial equilibrium approach, to inefficient or maybe not the best solution on local equilibrium. However, they lead to something that is consistent over time, and we would not have the kind of European integration now. We would not have the euro should we, let's say, go for a case for violating the rules when it is convenient. So we cannot get to the euro area on the one hand via convergent strategy, on the other hand via divergent strategy. That is not feasible, and I'm expecting nevertheless that the euro area will enlarge substantially in the next few years. I think the final point on crisis within the euro area, I think here I don't have to elaborate. I repeat word by word what Commissioner Almunia said when the question was asked a couple of weeks ago. We are politically, intellectually, and economically ready. we will see it if you are put under pressure, what that means. I'm not going to elaborate further. On global architecture, I think there is, I think we are discussing, I think there is not only with the US, I think as part of the G20 to, let's say, convergent in regulatory framework. I think there is still a different interpretation across the Atlantic of what better regulation and more oversight actually means. I think there is, we do not always use the same concepts. I think there also, if one looks at the new consensus, if I look at Washington summit in November, look at the London summit now, I think we have converged, but we have not converged halfway. I think we have converged more on traditional European views than on classic American views. But again, there I think there will be more work to be done, and I would hope that in the next summit we will make some further progress on that. Thank you.